Hi there, this is Mike Kramer of Mott Capital. Today is Tuesday, March 19th, and it is around 6 p.m. New York time. Tomorrow, obviously, we're going to be getting the big Fed announcement. While the Fed is not expected to change rates, this will be a meeting that does release a summary of economic projections, and everyone will be focused on these numbers down here, which are basically what the Fed is projecting for the Fed funds rate to be by the time we get to each respective year, and then the longer run rate. So just really quickly to go over what we're looking at. The Fed was pricing in rates in 2024 4.6% and 2025 at 3.6%. And these are just sort of important starting points because I thought I would just take a moment to show you how the market was thinking about this. And so when we look at the Fed fund futures, at least for the 2024, for December 2024, we're looking at a market right now that's pricing in a Fed funds rate of 4.7%. So that would be higher than what the Fed was looking at basically back in December when they issued their last projections. And then when we look at 2025, the market right now is pricing in a Fed's funds rate of 4%. That would also be higher than what the Fed was expecting at the December summary of economic projections. So basically, at this point, what this is telling us is that the market has removed rate cuts from 2024 and from 2025 and is projecting a more hawkish Fed tomorrow when they come out with their new summary of economic projections. So everyone will be focused on those numbers very closely. And when we look at where the two-year rate is, we can get a sense that rates and the dollar specifically are at these important inflection points where you have the two-year rate, which is essentially kind of butting up around this 475 area. This has been a big area for some time. When we just start going back and looking, this was one of the original highs back in November of 22. Of course, we ended up going higher eventually and then came back down. But again, this level has some importance because if we break above it, this is going to be an indication probably that the Fed is more hawkish, that the market is now adjusting for a higher for longer policy path. And that could potentially send the two-year rate back up to around 5% because you can see that the two-year fell very quickly back here at the end of November. And essentially, it wouldn't take very much. It would almost, if we were to treat this and we were to think about it as like a gap fill, that's sort of what this looks like. And so we could very easily move back up towards this 5% level on the 2-year. And certainly we can see the longer term trend line has been broken. When we look at the 10-year, we can see that there's a trend line that's already been broken. We can also see that we're approaching and at this 435 area, I'm calling it. You can see this is an area we've tested on several occasions. This, of course, was the January CPI report that we got in mid-February. This was the February CPI report we got in mid-March. And you can see that basically the 10-year rate is also at an important inflection point. This is also an point that dates back to October of 2022. So again, these levels have meaning and they do have importance. And at least the last time we got to this level, we actually did something sort of similar where we came up to it, tested it for a few days, came down, hovered below it for a few days, and then eventually moved higher. So a very similar sort of setup and pattern here to what we saw actually back in the fall, August and September of 2023. So this is going to be an important thing to watch tomorrow because if we see rates move up, you would think that you would start seeing the euro move down. Now, we talked last week, we were saying that the euro looked like it was positioned to maybe go back up and retest this region in here, while a retracement might find support at this 108.5 area with the potential for us to move back down to this 107. It's looking like, at least if we were just to base it off of how the Fed fund futures are pricing, if we do get that sort of more hawkish Fed out of tomorrow, I would think that you would likely see that the euro would begin to decline towards this lower end of the range at this 107.5 area and potentially back towards this 106.5 to 107 region. I mean, clearly the momentum in the euro is still very bearish when you look at it in the RSI, and you can argue whether or not this is a diamond reversal pattern. It certainly looks like it could be one with this straight line rally, and so obviously if that were, it would suggest there would be a significantly further to fall, but first we need to fall outside of this upper trend line and probably break this 107 support region. When we look at the pound, The pound has actually reversed. And now, obviously, the BOE meeting is coming up on Thursday, and so it's kind of hard to assess the market reaction in terms of where the Fed is going to be, and then where the Bank of England is going to follow up with. But clearly, this area in here at this 127.90 region is an important level. We tried to get above it, and to this point, we failed. So we're going to watch right now this 127.35 area, because if we can't get back above it, then we're talking about a retest of 126.30 and potentially a retest of 125.40. Likewise, I would think if we get back above this 127, if we get back above this 128 region, we probably move higher to 129, because that would tell us that basically what we're doing here is putting in higher lows and higher highs. Now, the BOJ actually had their meeting the other night, and the BOJ did actually what everyone was expecting them to do, which was to come out of negative interest rate policy. They ended yield curve control. They also announced they weren't going to be buying ETFs anymore, and that led to this. Despite all of this, the yen really weakened pretty materially today versus the dollar following this news overnight. And so that was sort of surprising to a lot of people. But again, this news had already been, I think, so priced in for the most part. Really, we're going to start getting a better feel in the next couple of days in terms of where the yen is going to go. We certainly got down to around this 146.25 region, and then we've moved up very quickly back to this 150.85 area, with clearly this level here, 151.64, sort of being key. Certainly with the BOJ not really committing to more rate hikes, and the BOJ's message around financial conditions still being accommodative, it certainly lends to more of that dovish side of things, and that really could be one reason why we also saw the yen really rally pretty significantly today. And it's another reason why we could see the yen challenge this 151.65 area and potentially move even higher than that. I mean, this is the upper end of the range. We know that the Japanese officials and government likes to intervene when we start getting around these areas. Again, I guess the point being is if we were to get back up to this area, you really have to wonder if they're going to intervene, because their best opportunity to have strengthened the yen would have been to deliver a more hawkish message, but they didn't choose to do that. And so you have to think maybe there's some room to the upside here in the yen breaking out above the 151.65 area. Clearly, if we fail at this level, that's going to tell us that this is probably about it for the yen. We're at the upper end of the range, and we're going to probably start taking out this low here at 146.60. And at least when we move on to the FTSE, the FTSE really just hasn't done very much. We have moved up just a little bit, but again, for the most part, we're still sitting at the 77.80 region. It looks like we're potentially forming an ascending triangle pattern, which would suggest maybe we can see the FTSE break out and move back up to this 79.20 region, which was a high from back here in April of 2023. So you're talking about an index that's done basically nothing for really since January of 2023, more than a full year. And then, of course, there's the DAX, which doesn't seem to come down. And we've seen the DAX sort of stall out a couple of days here. Really no indication that the DAX is ready to have a meaningful reversal of any kind. Just because we're still, very well above the 20-day moving average. We're still above the 10-day exponential moving average. About the only thing that's bearish on this DAX chart right now is that you have the DAX overbought with an RSI at 76, and you have it kind of just stalling around this 18,000 area. So until you really see the DAX at least break something here, then you have to think that the bias is still higher, with the potential breakout above 18,000, setting up a move to around 18,180, which would be the upper Bollinger Band. While if we're not able to break out, you're going to find support probably around the 10-day exponential at 17,865, and then again at 17,700 or so. When we turn over to the S&P 500, Sort of an interesting consolidation pattern going on here. I thought it was really interesting and sort of neat how nicely you can draw these parallel channels out. Obviously, it's easy to do that here, but it's also interesting how these parallel channels work so nicely on the rising portion of it. It sort of creates this parallelogram looking shape. I guess you could even maybe put it in that rising triangle, ascending triangle type of shape. But the thing with the S&P obviously is we have the Fed tomorrow. If the Fed is sort of more hawkish than as the market is sort of projecting, maybe taking away a rate cut. If you see rates break out, then and you see the dollar begin to strengthen, then you have to sort of wonder, how does the S&P really rally? Because overall, if you start really seeing those trades gain momentum, you would think financial conditions tighten. So the other piece here is that the call wall on the S&P is around 5,200. That's the level with the most gamma on the call side of the equation. And so that's going to potentially serve as a resistance zone too. So while it's possible we can break out and we do have this ascending triangle pattern, 5,200 or thereabouts is probably the upper end of the range, at least when it comes to the upside. When we look at it from a downside perspective, we'll see that you can see we're trading just a bit above the 10-day exponential moving average. That's been holding as support. Again, if we're sort of in this consolidation wedge here, then we're also kind of running out of room. So you only have a couple more days until you're going to find out whether or not you're going to break out or come back down. If this is sort of a diamond reversal pattern or parallelogram, however you want to describe it, I guess you could put a parallelogram and a diamond in the same sort of category. Certainly you have the two touches on the top, you have the two touches on the bottom, and so depending upon how you're going to break here is largely going to send things off. But I would think if you break the lower bound this rising channel, you're going to see this ultimately this gap fill at 5,080 or so. When we move over to the NASDAQ has also got this sort of confusing situation going on, because again, it's sort of just consolidating at this point as well, not really making any clear indication which way it wants to go. We basically are in the same exact spot we were in on February 12th, which was ironically the day before the CPI report that we got on February 13th for the month of January. The market hasn't really made much progress over the last couple of weeks. And the question here again, is this a falling wedge pattern? If this is a falling wedge, then perhaps it suggests we break out and fill this gap, because there's a gap here at 18,225 and then potentially retest this upper level at 18,400. If this is not a falling wedge, and instead this is some sort of reversal pattern, then I would think we're going to break this lower bound here at 17,760 and also work to refill this gap here at 17,460. When we look at the Dow here, you can see that the Dow really hasn't done very much either. It has performed a little better than the NASDAQ. You can see this was February 12th. This is where we are today. Again, I think for the Dow, it's fairly straightforward at this point. You have upside right here at 39,280. That's a clear resistance level. Likewise, we have this hole-in-the-wall gap right here down at 38,720. And these tend to fill fairly quickly, so it wouldn't be surprising to see this gap get filled at 38,710 at some point in the near term. So that's pretty much where we are right now. I hope this helps, and we'll see you next week. Bye.